So Peter, we're talking about financial support directions. Can you just explain exactly what one is and when the pensions regulator can impose one?
Okay, so an FSD is in effect an order by the regulator requiring typically other group companies to provide some form of financial support to the sponsoring employer of the scheme. In the first instance, probably by way of something like a parental guarantee, but potentially actually cash contributions as well.
Okay, so we're looking at that situation where there's a group of companies and the actual sponsoring employer of the pension scheme is not well enough resourced to support it?
Yeah, so the sort of starting position is you need a sponsoring employer which has one of two characteristics. Either it's a service company, so its turnover is derived pretty much exclusively from the provision of employees to other companies within the group, or alternatively it's insufficiently resourced. Insufficiently resourced, quite a complex formula, but broadly you're looking at a sponsoring employer that has resources that come to less than 50% of the buyout debt, and then you need another company within that group that will make up the balance of the 50%. If you're in that territory, then you could be vulnerable to an FSD.
Okay, so that's a situation that we do come across quite often where an employer is quite small relative to the size of its pension liabilities. So Peter, when would it be reasonable for a financial support direction to be imposed?
Well, there are a number of factors that the legislation lays out specifically, but it's not an exhaustive list, so the regulator has got a wide discretion to decide when it might be appropriate to impose an FSD. And certainly, a situation where the pension scheme relative to the size of the sponsoring employer or the employer group would be a typical example of that. And the regulator will be looking for things like the connection between the target and the employer, the degree of connection between the target and the scheme, the financial circumstances of the target, and any benefit that the target has derived from its involvement within the wider group.
So like you say, it's really pulling together that whole picture of the relationships.
Yeah, absolutely.
Yeah, which is quite a big exercise actually. It would take a lot of resource at the regulator.
Well, I think that is sort of currently one of the concerns that obviously we've seen some very big corporate failures over recent years, Nortel and Lehman's for example, and it is quite a challenge there for the regulator to put this type of case together over a relatively short time period if they're looking to pursue the remedy.
And what factors does the determinations panel tend to take into account?
It's the determinations panel that needs to be satisfied in the first instance that the FSD should be imposed. It will have seen the reasons that the regulator has for believing that that's appropriate, having considered the provisions in the legislation, but the determinations panel needs to be satisfied. And what's quite interesting is that the determinations panel have been satisfied that the regulator should take quite a wide view of its powers. So the legislation talks about any benefit that might be derived. Yeah, exactly. The determinations panel are saying, yeah, we're happy that the regulator looks at it in really that literal way. So in terms of factors that might influence whether it's reasonable to impose an FSD, you get an interesting mix between perhaps the direct and the less direct financial benefits. So tax advantages, for example, were seen as delivering a benefit. Commercial advantages arising from the fact that the group was run more or less as a single business without regard to the separate legal entities that existed within it. Those were a couple of cases where more indirect benefits were taken into account. And then, as I say, you've got direct financial benefits, so a target perhaps controlling or limiting the extent to which the sponsoring employer can fund the pension scheme and deriving benefit obviously from finances kept within the group business as a result, secondments of employees between the target company and the employer. So you get those more direct benefits feeding through in the determination panel's view as well.
And then looking at things from the other side, what are the key issues for trustees to consider?
Well, two or three really. I think firstly, although it's not their power, plainly they will be affected, their members will be affected by the outcome of the FSD process. So they will get notice of the relevant hearings, they've got an opportunity to appear and make representations. So there is an engagement for them there, even though they won't have initiated the process. I think secondly, as we were saying earlier, there's a lot of material that the regulator needs to collect and review. Some of that material may come to the trustees as part of their covenant monitoring process. So they may have information that it would be useful to share with the regulator. There may be situations where they see a need for an FSD. They might want to initiate some discussion with the regulator about that. So I think that's another area where trustees have got a role here in encouraging the regulator in those ways.
Yeah, and the regulator having that power actually sort of strengthens the trustees' bargaining position, I guess.
Yes, well, it's you don't necessarily know what's going to happen. I think what one has seen so far has been the power used most frequently in relation to companies that have already become insolvent, and that raises a whole suite of other difficulties. But I think we're seeing a little bit more appetite from the regulator to look at companies that are still solvent, where some of those complexities won't arise, and certainly, as you say, it's potentially a useful additional element in the trustees' negotiating position.
That's a very significant development then in this area.
I think so, yeah.